All right, everybody. Next up, we have Nic Chahine. I see Nick's been active in the chat. Nick is our options expert. I've known Nick for years. He's been a great friend of Benzinga for years. I will go so far as to say that Nick is probably one of the top options traders in the world. So he's asking everybody, what's your level of options experience? I threw that out there this morning, Nick, too. I was getting a lot of beginner intermediate. So if you want to start from the ground up and work your way up, that might be a good way to go. But Nick, take us away. Tell us about yourself, about your trading. Again, this is the man for options. So if you've got options questions, make sure you get them in the Q&A, and I'll be relaying them on to Nick as we go.
Sure. First of all, let me make sure that you guys can hear me.
Loud and clear.
Loud and clear. Okay, so am I sharing my desktop as well? Because I'd like to do that. Luke, if you can hook me up there.
Yep. Let's see if I can.
Because last time I did that and then works well.
Yeah.
Okay, so
and Nick, real quick.
Yeah.
I believe that you've got to share it. If you have the Zoom open, there should be a button at the bottom towards the middle that says share screen.
Yep. I got you.
All right.
There we go. I'm sharing. Let's see here. I think this is it. Share. All right. So you see that red thing going around?
I see the red thing going around.
Okay. Perfect. Okay, folks. First of all, I don't know Chris, but he's my hero. I always say that I'm Main Street investing against the Wall Street shenanigans. And what he said, this was my first introduction to him, and I agree with a lot of what he's thinking. So this is kind of like a preparation to my train of thought. Forget what you know. I promise you, if you get to know me, I can convince you things that you go, what? Right now you call me crazy for saying them, but I can convince you, proof, 100%. Anyway, so today we're going to talk about options, but I do have two goals. But first, the disclaimer is that, everything is risky. Duh. Okay. So we have to put that up. And so about me, I'm an engineer that went into marketing and then finance, and then did a couple of, joined a startup, then my own startup, and got lucky that way. And then I decided I was trading all along, and then my trading style changed. And now I strictly do nothing but trading. And my style is using options. And although I do agree with some of the stuff that Chris said, I can elaborate furthermore. I don't disagree with the rest. I just, there's so much more that he couldn't pack into the conversation. So, but it all starts with the basics, and the basics are very simple and they're repetitive. Today's point for me is to convince you that every one of us that invests, whether you do options for a living or not, if you have stocks, you have to know options, because during tough times, you could protect yourself for free, for example. So, but it's not as easy as said, but it is easy. But you do need to learn the basics of options. So the first step is to actually demystify them, because they talk Greeks and theta burn. Why don't they just say time? Why slap a Greek word to it and call it theta? That's bullcrap. So it's very simple concept. And they want to convince you that it's so complicated that you have to hear and listen. And the easy thing to do is to develop your thesis, do your trade, and manage it through option, or completely trade it through options. So I'm going to start with testing you guys and gals and see if, I'm going to give you a second. I'm not going to look at your responses, but I'm going to give you a second to define risk. And I promise you that not one person in the, 10, 12 years I've been doing this has given me the right answer, at least the answer I'm looking for. I'm going to give you like 2 seconds. Play the Jeopardy music. Define risk. I bet you most of you are saying how much money I can lose, not to risk more than I can afford to lose.
Yep.
Okay, here it goes.
So that's what I'm seeing.
Okay, so I'll give you my take on it, and this is the game changer really, because it just says, how do I manage my problem or my profit? So risk is, other than the reward, everybody's got their carrot, whatever the reward is. The risk size, how much can I afford to lose, right? That's the dollar amount, how much. That you set it at the beginning, and then you put it aside. That doesn't change. You don't manage that part. That part, you accepted the risk. I bought Apple at, it cost me $50,000. And that's my maximum risk. I can lose all of it if Apple goes to zero. I accepted the risk. Now, what do you manage? The second part is what you manage. What are the odds? What are the odds? What are the chances of me winning and losing? The percent. That's the part that we manage. Everybody else misses that part. They all concentrate on how much can I lose. So for those of you who already have dabbled in options and have sold spreads, I can guarantee you that at some point in time you thought about, getting out of a bad situation and you quote roll it somewhere else to make it try to survive. And then this is the bad part. I added contracts to make up the difference. If you don't know what that means, it doesn't matter. But if you've done it, you're probably laughing your ass off right now, because this is the bad part. You're adding to your problem. So it's important to manage based on percentages, not size. That's really important. That's where the risk management gets people in trouble. So you have to know what to do about it, but not add to it. So basically you want to look at the bottom of the page, you see what to trade, where to trade, when to trade it, and how to manage it. So that's basically the secret sauce. So traditional investment, everybody knows you buy a stock and hold it, and goes up or down, or you sell a stock and short it, and then you make money. So this is the traditional way of doing business. It's good, but it's not as good as options. And let's start. Okay, so what are they? They came out of the 1800s, I think, from futures contracts. So what is that? Real simple. If you owned a pizza shop and your main ingredient is cheese, and cheese price goes up and down, but you can't change your pizza price up and down, so you wished you could just fix your cheese price. So somebody will do their homework on cheese and say they know cheese inside and out. So they'll say, okay, I'll give you your cheese for $2 a pound for the whole year. Pay me for that premium. So you lock your contract at $2. They manage the price up and down. They make money at the one day, they lose money one day. For you, the P&L is stable. You can offer the pizza at a stable price. This is where options came from. So basically they're contracts, nothing more, nothing less. Okay, so they have time. You have dates, and I'll show you in a little bit what they look like. And it's called an expiration date. So I can buy an option for today in a few hours. In fact, I have a few that are rolling right now. So I have one eye on the left screen. And they also have a strike price. Like I said, $2 for cheese, right? In here, it would be something like, Apple at, $300 put or something. So it's a strike price. And then it's got to count. Every contract is 100 shares. They make mini contracts for 10, but let's go with what everybody talks about. So this is where the leverage comes in. So if I wanted to protect shares, I can do it cheaply, relatively cheaply. If I wanted to buy shares, but I don't want to commit the full 50,000, like I just said, for example, for Apple, I can do it cheaply by call options. So, and you hear the term in the money. It may be good, maybe bad, depends if you're buying or selling. So it's set in the money when price hits it. So if you buy a $300 put and price goes to it, now it's in the money. Okay, so now I want to back up. Usually I've never taken an options class. I learned all this crap on my own. And I can tell you that every selling point to every course I've read out there starts with a paragraph, most options expire worthless. I don't know how they can prove that, because a lot of the trades are done by spreads. So one loses, one gains, but it doesn't matter. Let's assume it's correct. Then why are you buying them? Wouldn't you rather sell them? If 80% die worthless, you should be the seller all the time. And that's why I prefer selling options than buying them. But step one is to understand how they act. Reason for success is if you can avoid the obvious mistakes. All right, so traditional investing using options. Right, so traditional investing, you buy the stock, you have a 50-50 shot of making money. You have to invest a lot of money. So especially if you're buying big stocks. You got two strategies, long or short. You need to be very precise because you don't have buffer. And you may do margin. Like sometimes you don't have enough to buy and the broker will give you margin, so now you have to make up more profits. Well, on the option side, it beats it in all cases, because better bang for the buck, and I'll show you proof. I choose my chances of success. Chris before me said he likes to buy at the money, so he's playing the 50-50 shot. Every contract at the money has a 50% chance, theoretical chance of, if you look at the delta, it'll tell you that it's basically a coin toss. Again, they call it delta instead of odds. If you go lower to buy a put or higher to buy a call, then your odds drop. And there is a sweet spot. Buying at the money works because you only have to pick a direction and not the size of the move. But buying at say a 30% chance of success, if you're buying for a lottery ticket, then it's a sweet spot that works in some instances. So it all depends. Okay, smaller dollars at risk. You can risk $200, $300, $100 to buy into a stock without having to shed $10,000, $15,000 to bet on it right now. Hundreds of ways you can do it. Literally unlimited ways of you can do it. I have 2 complicated ways going on right now. And I almost wish I didn't do them on a day like today because I'm here with you. So you don't need to pick a time frame. You can kind of bend time, Also, I'm referring to Chris because he started you with the conversation and I'm picking up on it. So you can bend time, so to speak. If I wanted to bet long on a stock, I can use the options to bet long, but with 30% buffer, meaning it can fall 30% and I still win. You can't do that with stocks. You bet now, you're on the line now. There's no buffer. So that's one way of doing it. And there's no borrowing. There is margin, but it's not to borrow. It's a different kind of margin. You risk cash. If you have it in an account, they'll let you risk it. If you don't, you can't do the trade, period. You don't borrow. So you can't lose more than you have. When you borrow, you can lose more than you have. All right, so bigger bang for the buck. This is today. Canopy Growth, pot stock, fell 20% on bad earnings, right? 20%. So if you shorted it yesterday, you made 20%. If you shorted it through puts, you made 300%, 200%. So clearly there's a better bang for the buck. And these guys lost because of time. They went too bearish. So at the time I took the snapshot, price didn't get to it, and there's only 1 day left. It expires today. So they lost. So while
we've got somebody asking if you can zoom in on that image at all. I don't know if that's
possible.
Sure.
What part? I can't zoom in, but I can do this for you. So I was showing you the top left, 20% down. You see that where the red arrow is? I'm going to go down to the put sides. These are the puts that were expiring today. They're up 300, 200%. So somebody that bought it yesterday, they made 300, 400%. If you guess the right direction, you make money in stocks, but you make way more money percentage-wise in options. And you risk less. So these guys risked 90 cents to take this bet right here. Check that, 40 cents. And the total now is 197. The change is $1.50. So I'm doing
so just to summarize, so they spent 40 cents to buy the put contract.
Right.
And now that contract is worth, you said, what,
$1.97. Let's round them up. If they bought it for 40 cents, the total cost for the trade would have been $40 because It's 40 cents and each one is 100. So you multiply the 40. So out of pocket, the transaction would have been yesterday. If they bought one contract, if they bought 10 contracts, they spent $400. If they bought one contract, they spent $40. And then today they could sell that contract for $2, $197 here. And that would, if they did one contract, it would be $200. So they made 200 minus 40 is their profit. They did it 10 times. They risked 400 to make 2,000 minus 400. So it's a bigger bank. It looks easy, right? But it all started with a trade. They saw something, they took the trade, just like, any other trade. But we cover everything. And it's all tied and it's all logic. It does not need jargon. I promise you that it does not need jargon. So this is how it is with these guys. The options, let me go back into it. So the options chains look like this. And I said they have dates, right? So this contract expires, which I'm at right now, expires on the 29th. They have one that expires in 1 week and then a week after. This is the June monthly contract. That's why I changed its colors. Every week they have one. And then you get to July and then October. Sometimes they don't have, depends on the ticker. Some tickers, like the S&P, they expire every 3 or 4 days. They have one on Monday, one on Wednesday, and sometimes 2 on Friday or 1 on Friday. And they wouldn't have a break here. They would show monthlies all the way out. Now you can bet on companies out in time to next year, January 21 or 22. These are called leaps, especially this one. So if I wanted to go along Apple through next year, but I don't want to risk $320 or $319 today, I can buy the call option out in time to that date, like this year or that year, and spend a fraction of this. So if it's $5 to buy, so I lock my price at whatever price, at $320, and I pay $5 per contract right now, which is $500, and that reserves my price. If Apple runs to $400, then I can buy it at that price. So this way, I'm long Apple. I didn't commit, dozens of thousands of dollars in order to do that, and I'm happy, because if it rallies, like I think it does, but I don't want to risk all that money, the call options will let me do that. Another way, I'll give you the perfect trade that I like to do. This is me making money by sitting in headquarters with binoculars, not in the trenches fighting the wars. Okay, so AMD, everybody loves AMD. I'm gonna go right now. All right, so we're on the fly here. This is a live trading platform for AMD right here. This is a paper trade account, so don't try to peek at the amounts. So here's what I did during the crash of COVID. So AMD is $52 now, correct? Okay, when price was falling, AMD was falling fast. It's the momentum stock, correct? So in fact, here, we'll go to AMD right now. So I'll go to a daily chart so we can see the crash, how it happened. I'll take out all the lines because it's a lot of noise. Boom. So the price was falling. Somewhere around here, I sold and I shared a trade with the group, and I said, I'm selling puts for AMD for October at $22. So you can't even see where $22 down here. $22 is still lower, right? So I said, I'm selling puts.
Yeah, really quick. Can you explain just the mechanics of selling a put?
Yes, I'm going to show you. I'm going to show you exactly.
All right.
So I'm telling you my favorite way of trading. When you see a good stock that you like and it's falling on bad day, you say, okay, somebody's panicking. Let me sell them a lottery ticket that's going to lose for them and win for me. Or let me sell them insurance. So I went out there, basically, I said, I sold the put. So in essence, I said, hey, who wants to sell their shares at $22 if it falls below 22? Somebody said, oh my gosh, let me out of my stock at 22. They paid me $2.20 per contract.
Wow.
So if I did 10, twice. So because I didn't catch the bottom, I did it here and then it fell again, and I did it again here for July. Same deal. So I'll show you. So let's say today I want to do it. Let's say I want to buy AMD at $42. Let's say I wish I had bought AMD at 42, wherever. Okay, here. I wish I had bought the bottom. Okay, let's say I just missed the COVID bottom. Okay, so here it is. I can do it right now. If I do this, I say, this is the put. I clicked on it and I say, sell it. So what's going to happen is I'm going to hit preview, and you can see I'm selling the put, right? And now it says credit you received, $2,800 minus $5 fees, $2,800. If I hit send, this is a paper account. I don't know if it's going to fill or not. So I'll hit send, and it'll be dangling there. So now I'm going to ask for less so it can fill. Okay, so. Ugh. All right, we'll give them the price they're asking. Okay, give me the bid. Come on, people. So what happens is the outcome, now I'm bullish AMD. There we go. Money goes into my account. So I'm going to show you. My account would be, I have now, I'm short minus 10 October 42 puts. So this money, it says minus because it's my account. But if you had a business and you collected money and you haven't performed the services, that money is not yours to use. It's still a liability until time runs out. Okay, so how do I win? Well, it depends on your perception. I win if nothing happens. I win if AMD falls, but not more than, where are we now? Here. Did we? Oh, 42. Sorry. So if it falls 20%, I still win. So AMD can fall 20, and what happens? The money I collected today, the $2,700, goes to zero. That's what theta does. So when I sell puts or put spreads, time is on my side. Every tick, the price is not at my price, then my odds of winning are higher, provided the price doesn't crash But the liability is if it does fall below that, I can be put the stock. And I say it can be because it's not always the case. I sold puts this year on US Steel at $9. The stock fell to $4 and they still didn't assign me the shares. Don't know why. They were morons. So they made a mistake. I won because they made a mistake. So in any case, this is exactly how I like to trade. If I do my homework, I see an opportunity, I pounce on it. I sold the 22, not 42 in my case, the 22, and I collected almost as much as what I just collected with you guys here. So this is how I meant you bend time. I'm long at 42. So if it falls to 41, I'm still profitable. Why? Because I collected almost $3 to get in. So my break-even point is 42 minus the $3 I collect, or the 250 I collect. So if it falls to 42 and lower, they'll put me the stock. I'll wake up owning the stocks. And then I wouldn't lose money until it falls below the amount I collected. Because I collected 2,700, I keep that. So I can, the stock can lose 2,700 for me and I'm still be even. So how can I get out of that trade? Just sell the stock if I don't want it. But if I want it at 42, I'll just hang on to it. Mm-hmm. Somebody in the chat room this week got assigned Boeing stock, and the person assigned them Boeing at exactly the bottom. So Boeing fell one day, somebody panicked, it closed 1 penny below the put they sold. They just put me Boeing stock. I said, you should smile. It's up like 3% today. That was the day it went up 8 or 9%. So he sold the stock up 8 or 9%. He kept the premium he sold. The person that gave him the stock lost a lot because they paid for the premium and then they gave away the stock at exactly the wrong time. They didn't have information on their side. So all of this is how options work. My secret that I'm going to teach you more if you stick with me is this stuff right here. This stuff. This is the secret that Wall Street doesn't want you to know. You would not believe how, not to say rigged it is, but how well organized it is. Tick for tick, you can almost predict how price is going to develop. I can't tell you which way it's going to go, but I can tell you exactly what's going to happen once something happens. I'll give you an example. Okay, every morning I share this, a map of what's going to happen. I'm going to go to 15 minutes. So this morning, this action was not here. All of this was not here. So I shared and I said, yesterday's lines were breached, and I had this note yesterday. It says natural magnet mini support zone. Look what happened. Boop, straight to it, and then bounced, mini support zone. So before the day started, I sent out a note saying, this is our new range, this here, this line, and this line. As long as we're between the two lines, nothing's going to happen. If we burst through, we're going to do this. If we burst through below, we're going to do that. So they went through below, and look at this candle. It entered my target zone, although didn't fill it perfectly. And I believe Mr. Trump was talking here somewhere sometime this afternoon.
2:30 it was supposed to start. So
okay, so the day is, they may still go down to here. But this is the benefit that I think I provide, is that I give you my guidance as to the price action. Believe it or not, I've turned into I'm going to sound pretty arrogant here, a pretty darn good chart guy. And I use fun stuff. I don't go out and tell you it's a shark or it's a bat, or although I know what they are, I give them funny names, So you got the head and shoulders. I can totally explain it to you in plain, simple English. The inverse head and shoulders, the cup and handle. It's all out there. It's in the charts. And I'm going to say something that's going to floor people and they're going to flip me off. And I can prove it to you over and over and over again. Headlines don't matter. In the last 5, 6, 7, or 8 years, only 3 headlines mattered. 3, that's it. The Trump election in 2016, the Fed flip in 2018, and the shutdown. All the other headlines, tariff this, tariff that. I bought every dip on the tariff, and I said, we're going to new all-time high. Everybody said, you're crazy. I said, it doesn't matter. We're not going to have a recession when everybody's employed. It cannot happen. Well, this year, it's completely the opposite. We've never been more unemployed. So they shouldn't be up here. So I'm expecting a dip sometime soon. So even though I am long short-term, I'm short long-term. I hope that makes sense. So we bought, for example, yesterday, I didn't know headlines were coming overnight, right? Yesterday, the charts told me I'm going short SPY. We bought puts in the SPY yesterday, and they're up 60% today because we woke up to this. So I didn't.
So let me ask you this, Nick. So this is we've gotten a couple questions on this. Is about time horizon. So as you're selling these options, what sort of time horizons are you looking at? And maybe use that Spire example that you're talking about.
Okay, perfect. So no, I'm going to use. Okay, I'll answer first on the SPY. So my short is on the NASDAQ for September. So because I expect that the reopening process is not going to be a disaster, but the labor is going to be a disaster. People are making too much money unemployed. I know from my friends. I go to a fighting gym. I fight for a sport. And most of the fighters are hourly, and they tend to be under $20 an hour. They're all making at least twice as much what they were making before, at least. So they have no reason to go back to work. So the metrics on unemployment are not going to get better anytime soon. That's my opinion. And it's going to cause a real problem going forward. And all this work from home is going to cut into, they're going to fire people, and it's going to get more expensive to find people because people will be able to job hop. And what happens is, as an employer, I used to be an employer, I would hate it if somebody wanted to leave because somebody offered them a job in China or wherever. I use China as like a faraway place. But they don't have to move to Philadelphia. They can get an offer from Philadelphia, work from home. So now I have to compete with Philadelphia market too. So wage inflation. So not a big deal, right? Well, a huge deal, because if wage inflation shows up, the Fed cannot put money into the system because that's one of their mandates. If inflation is here, you have to restrict cash. So right now they give $1 trillion overnight available in lending. Nobody's taking them up on it, but they will pull that back. They will stop buying stocks. They will stop buying ETFs and all that. So I'm bearish long-term. That's my thesis. The way I played it is I bought long-term puts, and when we get falls like this, I sell short-term puts against them. Complicated thing of saying is like, I'm kind of like booking some of the wins I have.
And when you're saying short-term, is that weeklies or are you going to monthly?
Yeah, I use the weeklies for that.
Okay.
So anything shorter that I think I have a vision on it. I'll give you a better example. I was writing up an order for Starbucks today. I think it's a good place to buy the dip. Today it was falling like consistently in the middle of the day, and I was wondering what the heck was going on. So I thought maybe I'll go long.
Sorry, let me interrupt you one more time. What size candles are those that we're looking at? Just so people have context.
Okay, we're looking at 15-minute candles here.
15-minute candles. Okay, so see, this is going back to the 21st of May.
Yeah, it's just a handful of days. And I wanted to see that I was going to walk through all the timelines. So whenever you make a trade, you should look at all different time frames. Everybody goes to the daily. They go one day, and this is a daily candle on Starbucks for about a year's worth of data. Okay, this is what everybody looks at. But then before I make a decision, I drill down to 15 minutes, 30 minutes, an hour, 2 hours. And then I also go to the weekly sometimes because I want to see the big picture too. Okay, what's going on here? How far are we relative to 5 years? This tells me that we're going into a resistive area, because if you look at it, they fell to here, they bounced. First of all, it was resistance right here at 80. It was very good support at 80. They couldn't even hold it because of COVID, and now they're back at it. So I guess that they're going to fight over it again. So it should be resistance. So I don't want to buy calls. That's how my decision, I wrote up the order. I haven't sent it to the membership. Okay. So I wanted to go and say, okay, I want to go long Starbucks. I like the company. It's going to have a new normal, but they'll deal with it. So I wanted to go long, but I didn't want to buy calls. So first of all, I'm going to put an alert here because I want to know if it goes above there to see if I want to chase it. And then one here, because this looks like where they're going to sell it when it gets there. So these are just side things. All right. So what I looked at is selling puts and put spreads. What does that mean? It means I wanted to sell risk down here and generate income from the risk. Okay. So this is where I'm going to put back my drawing and reset the chart. So there we go. I'm going to reset it to make sure that it's the same. Sometimes this platform goes wacko. Okay. So this is what I found. If I wanted to go long, I'll go out in time and buy like October or longer, call spread here or here. Depends on preference. Chris will buy it here.
Yep.
Because he said he buys at the money. I think there's a sweet spot here because of this. my opinion is, I drew this a few days ago. If they go above this line, see how if I extend it here, it's a trigger to go long. They're going to do this, fail, try again, and finish the job and fail here. This will be an exit target for me, for sure, for Starbucks. So I want to capture for cheap. I don't want to pay a premium. So it's either happen or not happen type of a deal. But that's not my, when I write it up, I'll say this is available, but that's not what I'm doing. If I'm doing anything, I'm selling one of these. So I either sell a put spread here, like in July, or I go out to October and sell it here. But when I go out to October, I can go lower, create a bigger buffer. So the only way I would lose if it's Starbucks falls, 20% or 30%, then I'm in trouble. Until then, I don't even worry about it. So how do these work? I'll basically saying Starbucks is not going down there. It may fall to here, and then people will step in and buy it. So why do I put them there? And why do I go to July and October? If I want to avoid earnings, that will be the July. If I can't, then I want to go way past the earnings. I don't want to short during the earnings. I know people get excited because they're more expensive to sell during the earnings, but it's drama. That's not me. I like boring stocks, boring trades. Boring is easy. You're happier. You're not plastered. It fits with your style, lifestyle. So
yeah, and Nic, just really quick, not to cut you off, but I think that's a really important point that you're making. Is and the name of your product too is create income. You're not looking for these lottery tickets. You're trying to generate these consistent options returns. So I think I really like that point you're making about you're either going before earnings or way after if you have to.
Yeah. Here's the thing. If people forget that there's such a thing called a market maker. Okay. So I made a point. I'll tell you something funny. The last presentation I did for Bazinga, John Nigerian was right after me. Okay. That's the guy from Trade Monster and CNBC. He's an options guru, him and his brother. Every time they go on CNBC and they say they're buying the so-and-so call. So there's another side to this buyer. So the buyer is buying them, but the seller thinks he's an idiot. So I don't know the buyer or the seller. Why would I want to side with one or the other? So every time they do that, I go out and I sell that as an experiment. And every time I've done that, I haven't done it every time. Every time I catch it, I did it with Micron. They did it recently. They're buying the 46 June call. So I sold the 47 call just behind it. And I'm winning. So we'll see. Yesterday they said SYF, whatever that is. I think it's a local bank of sorts. They're buying the 22 call or something that was huge buy. So it's a huge transaction. So I went out there. I mentally sold it because I didn't want to. I had enough trades on my hands, but I wanted to make a point to these people. I said, don't chase the headlines. I promise you, you will lose because then you become a sheeple. You're just following the herd for no reason. Do your homework, listen to the news, decide on your own. So I started by saying there's something called the market maker. They're not idiots. They don't lose money and they do nothing but sell options. They make the markets. When I'm selling options, I'm a micro tiny market maker. So when I sell a put, I made a market for that. That's me. But when the market makers do their bets, you're likely going to lose. That's why most options expire worthless because the market maker is selling them and you're going to lose. So unless you have a good reason to fight the market maker, don't. So when they say they're buying that call, who's selling that call? It's the market maker. They're not going to lose money. So even if it gets there, it's going to die right there. So if you want to bet on that, buy lower, like Chris said, buy at the money so you can profit from the move to it, not from the move at it. So that's my opinion. Anyway, for Starbucks, I just walked you through. I zoomed out. I wanted to catch a falling knife. Before that, I zoomed out to a weekly. I saw that it's going to hit resistance, so I don't want to buy anything. So let's see if I can sell something. So I zoomed in. I was like, hey, maybe I can sell something. I'm going to tell you why. This was the COVID crash. The world literally stopped here. It literally stopped. And that's the worst they could do. I'm willing to take a chance on it. So the only way that this will go lower is if we have another COVID crash and then go below it. That's why my personal preference for this would be the October bet. I think it was $1 to sell the October put or whatever. So if you wanted to see another example, let's switch to, I almost did Target again. What's with that? I've like never trade Target. So this is October. This is the put side. I know you can't see, but I'll explode it a little bit. Let's say, what did I say here? What was the number? 55? 52. All right, it's not even on this. Let's go with 55. $1. So I can sell. I'm going to go to the lowest. Usually I go to the mid and it'll fill on the mid, but here it's a paper trade, so it's a theoretical fill. So it'll take the worst case scenario for me. Credit you receive. If you can't see it. Okay, credit you receive. I'm selling 10 puts at 55 and I'm collecting $1,000 basically. Okay, so I'll get that out of there. Send it. And it filled. All right, so now I go to my account. I go to positions. I have two positions. I'm long Starbucks and I'm long AMD. I have minus 3,700 in my account. So if I do this 2, 3, 4, 5 times a year, I go to, and they all win. How do I win? I don't need anything to win. If nothing happens, I win. If it falls a little bit, I win. If it falls a lot of it, I win. If it crashes, I don't win. Okay, I own shares very, very low. That's what happens. So if time passes and nothing happens, now I made $3,700. Cost me nothing. Nothing went out of my pocket. I just showed you my account. Nothing. Now, I don't like to sell puts all over the map when markets at our all-time highs. Ooh, what just happened in the market? Holy cow.
We got Trump.
Oh, okay.
Yeah.
Headline. Okay, so the idea here is not to like open all kinds of risk, but this is better than buying Starbucks and buying AMD shares. That's way better because A, no money came out of my pocket. B, I have a 30% buffer for either of those. I'm rounding. And C, I can protect myself. I can buy short-term insurance. How do I do that? Very simple. So I just sold October at 55, right? Let's say I'm nervous for the next couple of weeks. I can 55. Okay, I can buy a $60 put. So let's go out longer in time. Let's go to July. Okay, I can pay 28 cents to buy the July put, and that covered me through July. Or I can pay pennies to cover me through July 2nd. So what does that mean, cover me? It means if it falls to 0, I'm temporarily protected. Because if it falls to 0, I am long committed at 55. So what happens is, let's say it falls to 50, and the person panics, like the Boeing guy the other day with my friend David, and I wake up, I own shares of Starbucks at 55. I paid 55 even though the price is 50 because I promised him I would. So now I'm down $4 a share. Why 4? Because I collected $1 to get into it. So I keep that dollar. So I'm only down $4 a share. Not a big deal for me. But if I buy a June put position for pennies, then I didn't lose anything because I'm short and long at the same place. So I can do to somebody else what somebody did to me. So somebody assigns me the shares, I can assign them somebody else at the same price. So it's an easy way. That's what I did with US Steel, and that's how I made money in US Steel, even though I couldn't believe it. I mean, the stock was, I was committed at 9 and it fell to 4, and they still didn't give me the shares. I'm like, please give me the shares so I can get out of this trade. Nope. So anyway,
and so let me recap really quick. And again, guys, notepad out. I highly recommend it. This is Nic Chahine we're talking to, one of the best options traders I've seen. So the parts of the trade, we got time horizon, we got price. For time horizon, he's trying to avoid earnings, so he's either going before it or way after. And then Nick, you identified the price to sell the puts at by looking at the low of the COVID move. So that's the worst they could do for it. You're comfortable coming in there, correct?
Yes. I only sell, here's the big thing, people. I only sell puts in stocks I can and I'm willing and able to own, okay? Because some people, unfortunately, these platforms will let you sell puts you can't afford to buy shares, which is insanity. They have a formula of sorts, and to them it's okay. To me, it's not okay. When I'm selling a put at 50, they say, and I start getting people, how do I defend it? It's like, why do you want to defend it? You committed to buying the shares. If anything, just buy a put lower, wherever you want to stop your bleeding as a share owner from there. First of all, you haven't lost anything, but it shows negative on my statement. Yeah, well, who cares? You intended on buying the shares, so it can show down $1 billion. The worst that can happen is you're going to buy the shares at that price. You didn't lose $1 billion. You lost nothing until you own the shares, and then they don't recover. Then you lose money. That's it. So if you can't do this, let's do another one. Okay, so
well, Nick,
here's another one.
Real quick. We've only got a handful of minutes left, unfortunately. So can I rapid fire you a few questions out of the chat?
Sure. First, I just posted the Bitly shorted thing. That'll take you straight. Join me. We can have this conversation forever. Hit me with the questions.
All right. Somebody's asking about the AC ticker ACB. They had a reverse stock split. Any action you would do there, anything you would do to manage around that, et cetera.
So if I sold a position or own an options position into a reverse split, it used to be where they changed the counts. These days, I don't think they did that because I had a position in the USO and that happened to it, but then now they have two separate different contracts for it. So I can't answer it definitively. I would have said a few months ago, I would have said they just adjust the count. Because one time I was in a CRM position and it split, so I ended up with 3 times as many. It split 3 for 1, but for less price. So it's potato, basically. It shouldn't change anything, except that now everybody loves ACV. So if you have that position, get out of it.
Okay. Another question we have coming from Mohammed. He's asking about your preferred software for looking at candles of options prices. Do you have anything there?
Candles of options prices. Okay, so I use Thinkorswim for all charting, for trading purposes, tracking live. I like this TradingView for actual homework, like I just did with you guys and gals. And as far as options, I have a giant proprietary setup that feeds into my Excel. So I don't know how to answer that. But like I just said, I mean, if you just wanted to look at the options, E-Trade has a pretty good options. This is actually funny. This I think was built by the Nigerian brothers under Trade Monster label, which then they merged with Options House, and then they got bought out by E-Trade.
Okay. We got PK asking for puts. Do we get to choose the expiration date and the price? The answer is yes. And then I'll give you one more question, Nick. Does it mean the buying puts? Okay. So the question is buying puts best when the price is highest or when the price is low? This is about buying puts.
Buying puts. Well, if I wanted to short a stock, the best time to short it is when it's rallying. Like I buy puts on up days. I don't rush to buy puts when the market is falling because you're paying too much for them. Unless I have a specific reason why I want to do that. It's like buying insurance when your house is starting to burn. Nobody's going to sell you that insurance. If they do, they're going to charge you an arm and a leg. So it's best if I wanted to short a stock or protect my stock is to buy when there's no frenzy to buying. Because whenever somebody's buying in force, and then the put options will be inflated. And let me see if I can show you a visual to it. But you can go ahead and tell me the next question. So look at this. Implied volatility is 200% on a day where it's falling hard. This is canopy growth. This should be like 50 for a hot stock like this. It's probably 30 for Apple, but it's 200% because everybody's rushing to buy puts. So pretty expensive.
Okay.
You're paying up 3-4 times over when we should be.
Awesome.